to another episode of Policy and Profits. I'm EJ Antoni, but the reason everyone is actually here is to listen to the one, the only Wall Street legend, trader extraordinaire, Anthony Esposito, founder of Ascalon 6 Capital. Anthony, how are you doing today? How was your week?
Week is good. Same as always, busy watching tweets, watching Iran, watching the markets. Micron earnings out, which has been exciting, but it's been a good week. We're definitely moving through some craziness in the markets as usual. How are you doing?
Well, moving through the craziness in the headlines as well throughout all the economic data. Anthony, it's such a weird time because on the one hand, you're watching everything. On the other hand, you can't watch anything because the news cycle has turned into not a 24-hour news cycle, but a 24-second cycle. So to a certain extent, yes, you have to keep an eye on everything, but you have to take all this stuff with such a big grain of salt. You don't know what's signal versus noise anymore. So, again, it's weird. You're watching everything, but at the same time, it feels like you're watching nothing because you don't know what matters.
You are preaching to the choir. We have our model is a momentum trend model, as you know, and we've done very well with it. But the whip and the pivots within the model, within the signal now, have just gone parabolic, and it's not even for any particular reason. It's sometimes there is no reason, and it seems like somebody's just kind of stepping in and putting their finger on the scale. And then sometimes it's a tweet or a headline or a tweet, and then a tweet that says that wasn't actually a tweet, and then a third tweet that says both tweets were wrong. I have the tweet. I don't, it's been crazy and it's been erratic. It's been really a ton of unknown unknowns, and it's just landmines everywhere. Definitely, I can say I traded through 97. I traded through the tech bubble. I traded through the housing crisis. I traded through COVID. Traded through 24, 25, traded through the tariffs, and traded through this war. And I can say that this war, bar none, and probably because of the access through Twitter, through X, and headlines, and the access to information and the use of information by everyone, and including the administration in the U.S., that information and the use of the social media and the headlines has made this absolutely the hardest market I've ever traded.
That's saying something.
It really is. I mean, everybody's dug in on the market. Everyone's dug in on buy the dips. We won't get into that. We have in the past, but we won't get into that. Everyone's focused on inflation, Iran, earnings, AI, token costs, capex spending, free cash flows going negative in the Mag 7, all these things, right? And the one thing that I think the yen carry trade, which no one's really talking about, which we will when it starts to unravel. The one thing I wanted to talk to you about, which no one's speaking about, and I think is paramount to the support of the market and the continued liquidity flow into the market, is the money supply and the amount of liquidity out there. So I'm going to shift gears from everything we've talked about and everything we're talking about, and probably most of what everyone's talking about. And I want to talk about the M2 money supply. We have a graphic up. Here's the M2 money supply over the course of time. This is 87 through today. That green line was Powell taking the chairmanship of the Fed, and the red line is essentially Powell not at the Fed anymore. That was a 65% increase in the money supply just under Powell, okay? And we are at, I guess, just over 2.3 trillion as far as the M2 money supply goes. So here's my question, because I feel like the liquidity machine is really what's leading this market higher and the fuel to this fire. I don't want to get into valuations and technicals and if there's a finger on the scale and all of that. Not an interest today. What I want to talk to you about and I want to hear from you is, how is the Fed continuing to increase this liquidity and the M2's money supply? And does that break? Or does it just go on forever? And what are the ramifications of both of those scenarios? The ramifications of it breaking and stopping, I know, are the market contracts and comes in. But how are we here? How far off the rails are we? And what's next?
Great questions. Essentially, the Fed continues to do two things. Number one, to allow banks to expand the money supply through their own loan-making process. That's where the real action is when it comes to growing the money supply, right? The other thing is that the Fed itself is adding the fuel to the fire because ever since December, they've been engaging again in T-bill purchases. So whether it's the Fed buying financial assets or it's in the private sector, the banking system making new loans, all of those things are creating money that didn't previously exist. And so as the Fed continues again to number one on its own, create money through the purchase of those T-bills, but number two, it's also allowing banks, it's not reining the banks in at all through the different levers that it has to do so. It's allowing the banks to continue growing the money supply as well. And the result of all of this is that you now have an M2 for the first time ever over $23 trillion. And we should also point out that the very fast rate of increase that we saw in the most recent month for which we have data, which was May, it's over 1% growth just in the month. So you're looking at an annualized rate in the double digits, and it's even faster than the rate that we had pre-COVID. So not only do you have the massive level change, right, because you were gradually rising, and then you had the huge spike during COVID, so you have the level change. Well, that'd be bad enough if you were still growing at the same rate, but now the rate is also exceeding the pre-pandemic rate too. So it's not a great situation when you look at where we are today and where we've been in terms of fighting inflation and what we have to look forward to, because all of this is going to, I think, continue to put upward pressure on prices. Now, relating that to the market, well, the market is all priced nominally, right? Nobody prices equities in real terms. The closest thing you have to anything being priced in real terms is you have certain inflation adjusted fixed income assets, and that's about it, right? So again, keep in mind, we're talking about assets that are priced nominally, so they're going to be affected by changes to the dollar. And I think that's what you're looking at here, Anthony. Okay, so that's a very long-winded way to answer the first part
Yeah.
of your question. The second part of your question was, what happens if you keep going in this direction, or what happens if if the Fed decides to take their foot off the gas and put it on the brake? Well, if we keep going in this direction, I think you're going to continue to see what we have already seen basically ever since the end of 22, maybe let's say the beginning of 23, because then you're past the initial phase of the regional banking crisis that we had, which is you're just going to have steady nominal growth in these different assets, regardless of increases in the underlying value. That's not to say there haven't been increases in underlying value in a lot of these companies. I think there have, but if you look at the whole S&P, for example, it's amazing how much of those increases are literally just the dollar losing value. It's literally just inflation. So you'll continue to have upward pressure on nominal prices everywhere, including equities, if you continue to see M2 growth like we've been seeing. However, if the Fed starts to rein it in, which is probably going to happen, I think once Warsh stops the QE and gets back on the QT path, in other words, they stop buying additional T-bills and they start selling off financial assets, particularly mortgage-backed securities, that's when I think you start to see a lot of this unravel. And it's going to be very, very difficult for the Fed to make that happen without causing basically what happened again in the spring of 23, which was a mini financial crisis, and you had to bail out the regional banks. So, but again, at the end of the day, regardless of whether Warsh manages it well, which I think he will, or whether the Fed manages it poorly, I think it has the same effect on equities, which is it's really going to slow the growth in terms of that nominal price. In other words, you're not going to see equities appreciating the way you have been. That's not to say you're going to have a huge sell-off and they're going to go down, but the upward pressure on prices is just not going to be there.
Okay, so first thing is, and this is a great breakdown, thank you. First thing is, and I always say this, everyone is enamored with the shiny ball of the Fed funds rate. Probably more important to focus on what they're doing with the balance sheet versus whether they cut or raise by 25 bips. That would be my opinion. Is that what you're saying? Is that how you would feel? That's how I look at it.
Yeah, absolutely. And part of the reason for that, Anthony, is because now with all the additional, it's not just SOFR, it's not just the Fed funds rate, it's the repo markets. There are so many different mechanisms in this giant web that the Fed has weaved that are all so interconnected that just because they put the Fed funds rate up or down doesn't mean they're not going to be able to basically offset that in other places. And so that's where, again, I think the balance sheet is going to be something very, very important to pay attention to. Don't forget that all of those assets that the Fed has on the balance sheet that it has purchased, that is the basis for the money that the banks are using to lend out. So you reduce that source of credit, you can cause a very large contraction in credit, broadly speaking.
And you also, and we talked about this in the past, but and this again, this is really important for people that are listening and are dealing with anything rate sensitive or the markets. This is extremely important, in my opinion. We've also talked about the selling of the assets on the balance sheet being mortgage-backed securities. As they sell those assets, it's just the seesaw of bonds and yields. As they sell mortgage-backed securities, they actually run the risk of rising the rates on mortgages versus keeping them lower, which is what obviously everybody wants when you're buying a home and what President Trump wants. So that activity not only would reduce liquidity in the system, but it would actually raise rates on mortgages. Is that fair?
You're absolutely right. Spot on, Anthony. And actually, my master's thesis was on looking at how different industries are affected by changes in the Fed funds rate, both output but also employment. And in terms of employment, it can vary based on a lot of other factors. But in terms of output, it's a very, very strong correlation, essentially, between the likelihood that a consumer is going to use credit to buy something in that industry and the output of that industry in terms of what happens when the Fed funds rate goes up and down. In other words, for a lot of consumer staples like toothpaste and toilet paper, things like that, there's essentially zero correlation. In fact, there's arguably a slight negative correlation with those changes in the Fed funds rate. In other words, the Fed funds rate going down does not equate to people going out and buying more toothpaste. But as soon as you start talking about things like appliances that people are more likely to finance, now output in that industry does go up because consumers demand more because the rates come down. You go to an industry like cars, it's even more sensitive. And then the most sensitive far and away is, of course, housing, as you're describing. So as the Fed sells off all of those bonds, well, guess what? There's not as much of a demand for new mortgages anymore, which makes it harder for the banks to sell those mortgages. So the banks are now less likely to give you a mortgage, at least at today's rates. It'll take a higher rate to make that happen. And so that's what you end up seeing there exactly. And as those rates tick higher, what happens to home sales? They go down. Output in the industry is going to fall. Absolutely.
That's incredible. Great connections here. I'm actually, I can't overstate how important I think this is and how it's overlooked across the board as we talk about the Fed and what's going to happen. I mean, I've talked to everybody up and down, friends at buy side firms, friends at sell side firms. I've read research, and as we've moved away from Powell towards Warsh, and no one is really talking about the balance sheet, the handling of the balance sheet, or liquidity. Very few people. I think this breakdown has been incredible, EJ, and very valuable. Thank you very much for the time. I'm on the show today, man. That's the show for me. I think this was incredibly important, and really, to anyone listening, you definitely want to focus on liquidity and rates, and not so much that Fed funds rate in particular. It's fine to look at it. It's fine to focus on it, but EJ did a great job of explaining why the balance sheet might actually be more of a focus and more of a key. Listen for that. Pay attention to that, because that's going to be the liquidity that either dries up and pulls everything back down and makes things more expensive as far as rates go, and and pulls the market in, or the liquidity that continues to be the gas on the fire. EJ, thank you, buddy. That was a great breakdown, and I think it's massively important.
Hey, Anthony, my pleasure. And I know it's probably not much consolation, but I hope in some way that clarifies for all the people out there who are trying to trade this absolute beast of a market. I know we've said that plenty of times before, right? It is a beast.
Yep.
But between the just constant changing of the news from literally second to second, it makes it almost impossible to do anything with that information. Hopefully, having some kind of information on what direction the Fed is going to go and the impact that those different directions can have can bring some kind of clarity and can I don't know, hopefully bring some signal to override the noise, as it were.
Yeah, yeah, absolutely, absolutely. And by the way, just as a point in closing, um, since the year 2000 through today, 65% of S&P earnings growth has been due to inflation. So we were talking about nominal versus real. 65% of S&P 500 growth has been due to inflation. So if you
Two
tell me we're
thirds.
not in a system that needs inflation to thrive and survive and move forward, I would say that that's not true.
Yeah, two thirds, and actually, Anthony, I would say that that's, I agree with 100% that that's true on the face of it. But then I think if you go deeper into it, and you look at how inflation has allowed these companies, a lot of the zombies that they talk about, right? How it's allowed those companies to continue. I would say that it might even be responsible for even more, because a lot of these companies use that arbitrage that inflation and low interest rates can give them. Look, in the exact same way that a very, very dear friend of mine has a mortgage right now at 2%, literally 2%, that this person and his wife got in COVID. And so every year since then, inflation has run hotter than that. And the bank has basically been losing money on their mortgage. I tell them every time I see them, you're stealing money. It's not right. But that's, look, that's, and that kind of arbitrage that they're doing there, where the interest that they're paying is less than the inflation rate, businesses are doing the exact same thing. And so you have to look and say, it, when you have a company like Apple that was better capitalized than a lot of major financial institutions in 2020, but took out all these loans
Yep.
because they were able to borrow money cheaper than the yield on their dividend and buy back their own stock and make money on the deal. I mean, it's insane. But that's, again, that's part of where I think the inflation even plays into there,
Yep.
where it's even more than just that difference between real and nominal, which is scary. And I think really reinforces your point, Anthony, that this needs inflation to survive.
Yeah. Yeah. All right, buddy. Thank you very much, EJ Antoni, at Real EJ Antoni. Always a pleasure. I am at CMT_Anthony, or you can go to ask16capital.com. EJ, you're the best. This was awesome, and I will talk to you soon, my friend.
Till then, thanks, Anthony.